One Up on Wall Street, by Peter Lynch. Introduction. In October of 1987, one of the greatest investors in history was on vacation. He was in Ireland, of all places, playing golf on some of the most beautiful courses in the world. He rarely took vacations, so this was a special trip. On Monday, October 19th, he was facing the 18 holes at the legendary Killeen course in Killarney. He played a full round, packed his clubs in the car, and drove with his wife out to the Dingle Peninsula, a stunning stretch of Irish coastline. They checked into a hotel. And for the entire afternoon, he never left the room. Because while he was trying to enjoy the rolling green hills of Ireland, back home in America, Wall Street was turning blood red. That Monday, the stock market fell 508 points. It was the single biggest one-day drop in history. In a matter of hours, $2 billion? That's billion with a B apostrophe question mark had been wiped out from the mutual fund he managed. The 1 million shareholders who had entrusted their savings to him were watching their life's work evaporate. He wasn't napping in that hotel room. He was on the phone, thousands of miles from his office, desperately trying to manage the financial storm of the century. He later said he couldn't decide if the world was coming to an end, or if just Wall Street was going out of business. That man was Peter Lynch. And the fund he managed was the Fidelity Magellan Fund, which under his leadership became the best-performing mutual fund in the world. The story of how he navigated that crisis, and countless others, is legendary. But the most incredible part of his story isn't about how he, a Wall Street genius, made a fortune. The most incredible part is that he believes you can do it too. Peter Lynch wrote a book called One Up on Wall Street that has sold well over 1 million copies. It's not a dense, academic textbook. It's a simple, powerful guide written with one core belief, that the average person, with just a little bit of homework, can pick winning stocks just as well as, if not better than, the top experts on Wall Street. And today, I'm going to share with you the timeless wisdom from that book. By the end of our time together, you will understand the secret edge that you already possess, an advantage that Wall Street professionals would kill for. You'll learn how to spot world-changing investments in your own backyard, at your local shopping mall, or even from the products you use every day. This isn't about complicated formulas or risky gambles. It's about opening your eyes to the opportunities that are hiding in plain sight. So, if you've ever felt that the world of investing was too intimidating, too complex, or just not for you, get ready. Because Peter Lynch is about to turn that idea on its head. And it all starts with a simple, revolutionary idea: stop listening to the professionals. Book summary. It's a strange piece of advice to start with, isn't it? Stop listening to professionals. If you hire a plumber, you listen to them. If you go to a doctor, you listen to them. But Lynch argues that investing is different. In this world, the so-called smart money isn't always so smart. And the dumb money, that's what Wall Street calls everyday people like us, is only dumb when it listens to the smart money. Lynch spent 20 years on Wall Street, and what he saw convinced him of this. He says any normal person, using just a tiny fraction of their brain power, can outperform the average expert. Why? Because you, in your daily life, have a powerful advantage. He calls it the amateur's edge. What is this edge? It's the power of your own, first-hand experience. Think about it. Long before Wall Street analysts write their fancy reports, you're already out in the world, interacting with hundreds of companies. Lynch tells a story about one of his best-ever investments. It didn't come from a secret memo or a high-level meeting. It came from his wife, Carolyn. In the early 1970s, she came home from the grocery store and told him about a new product she'd discovered. It was women's pantyhose, but they were packaged in these colorful, plastic eggs, sold on a metal rack right by the checkout counter. The brand was called Legs. Lynch was a textile analyst at the time. He knew all about profit margins and supply chains. But his wife, just by being a regular shopper, had stumbled upon a gold mine. She didn't need a business degree to see the genius of it. It was convenient. You could pick up a pair while buying milk and bread, without a special trip to a department store. The product itself was great, too. It was durable and fit well. Millions of women saw this. Store clerks saw it. Husbands saw the plastic eggs piling up. You could have walked into any supermarket in America and seen for yourself that this was a runaway success. From there, it was a simple step to find out that Legs was made by a company called Hanes, and that Hanes was a stock you could buy. Lynch did his research, confirmed the story was as good as it looked, and the stock became what he calls a six-bagger, meaning it went up 6 times in value before the company was eventually bought out. He's convinced it would have been a 50-bagger if it had stayed independent. And here's the most important part: you didn't have to be there on day one. You could have bought Hanes stock in the first year, the second year, or even the third year after Legs went national, and you still would have at least tripled your money. But how many people did? Lynch tells a funny, and all too real, story about a fictional couple, Harry and Henrietta Houndstooth. Harry is the designated investor of the family. He reads the Wall Street Journal, subscribes to expensive newsletters, and looks for exciting, high-tech stock tips. He's the guy who hears about Winchester disk drives and, without knowing a disk drive from a dinner plate, convinces himself he's done his research and invests the family savings. Meanwhile, his wife Henrietta comes home from the mall, raving about a new clothing store called The Limited. The place is packed, the clothes are great, the prices are a bargain. She's genuinely excited. But when she tells Harry, he just grumbles about her squandering money while he's busy figuring out how to make it. You can probably guess the rest of the story. Winchester Disk Drives has a bad quarter, the stock tanks, and Harry sells at a loss, patting himself on the back for limiting his losses. All the while, the stock for The Limited, the store Henrietta discovered, is quietly turning into one of the greatest investments of the decade. It became what Lynch famously calls a 10-bagger. A 10-bagger is Wall Street slang for a stock that makes you 10 times your money. If you invest $1,000, it becomes $10,000. It's the home run of investing. And Lynch's core belief is that these 10-baggers are not found in some obscure, high-tech lab. They are often hiding in plain sight, in companies we already know and understand. He gives so many examples. Dunkin' Donuts. Lynch loved the coffee. If you had invested just $270 in the stock in 1982 about what you might spend on donuts in a year, it would have been worth over $1,500 just 4 years later. Subaru. In 1977, you could buy the stock for the equivalent of $2 a share. By 1986, it hit the equivalent of $312. That's a 156-bagger. If you had invested the price of a car, say, $6,400, into the stock instead of the car, you would have made over $1 million. Taco Bell. Lynch was impressed with their burritos on a trip to California. The stock soared through recessions. Apple Computer. Kids had them at home. Then offices started buying them. The signs were everywhere. If you had put $2,000 into Apple stock in 1982, the same week you bought your first Apple computer, those shares would have been worth nearly $12,000 5 years later, enough to pay for a year of college. This is the amateur's edge. It's the power of common knowledge. You see, the professionals on Wall Street, the so-called experts, are often the last to know. Lynch calls this phenomenon street lag. Why does it happen? Well, think about the life of a professional fund manager. First, they are overwhelmed. Lynch himself followed 1,400 stocks at Magellan. Most managers cover hundreds. They don't have time to hang out at the mall. Second, they live in a bubble. They all read the same reports, talk to the same economists, and follow the same herd. It's safer for them to be wrong in a crowd than to be wrong alone. There's an old saying on Wall Street, you'll never lose your job losing your clients' money in IBM. If you buy a huge, well-known company and it goes down, everyone just shrugs and says, "What's wrong with IBM?" But if you buy some little-known company like La Quinta Motor Inns and it goes down, they look at you and ask, "What's wrong with you?" This fear keeps them glued to a pre-approved list of big, boring, well-known companies. They often can't, or won't, invest in a small, exciting company until it's already been discovered by dozens of other analysts and its stock has already gone up tenfold. By the time the experts are recommending the limited, Henrietta has already moved on to the next great store. This is your opening. The amateur investor isn't burdened by these rules. You can invest in a company with a silly name like Pep Boys, Manny, Mo, and Jack, a real company, and a huge winner. A professional might be embarrassed to recommend it. You're free to follow your own research, wherever it leads. But, and this is a crucial point Lynch makes over and over, liking a store or a product is not a reason to buy the stock. It is a reason to start your research. It's a lead. It's the first chapter of a story that you need to investigate. Finding a promising company is only the first step. The next is doing the homework. And this is where most people stop. But Lynch promises it's not as hard as you think. Before you even start looking at companies, though, he says you need to look in the mirror. He calls it the mirror test, and it involves asking yourself 3 simple questions. First, do I own a house? Lynch believes that before you invest $1 in stocks, you should consider buying a home. He calls a house a wonderfully rigged investment. Banks will lend you 80% of the money, giving you incredible leverage. If you put 20% down on a $100,000 house, and its value goes up by just 5%, you've made a 25% return on your investment. Plus, the interest on your loan is tax-deductible. It's a hedge against inflation. And, of course, it keeps the rain off your head. People spend months researching a house. They check the foundation, the roof, the schools, the neighborhood. But then they'll throw their life savings into a stock they heard about on the bus. Lynch's point is simple: apply the same diligence you'd use to buy a house to buying a stock. Second question: do I need this money? This is about your financial situation. If you're going to need the money in a year or two for college tuition or a down payment, do not put it in the stock market. Stocks are predictable over 10 or 20 years, but in the short term, their direction is anyone's guess. Even the safest blue-chip stock can get cut in half and stay there for years. The rule is simple and absolute: only invest what you could afford to lose without that loss having any effect on your daily life. This isn't gambling money. It's money you can afford to let grow, patiently, over time. And the third, most important question: do I have the personal qualities that will bring me success in stocks? What are these qualities? It's not about having a genius IQ. In fact, Lynch thinks the true geniuses often get tripped up by complexity. The math you need is stuff you learned in the 4th grade. The real qualities are things like patience, self-reliance, common sense, a tolerance for pain, open-mindedness, and humility. Most of all, it's about having the stomach to ignore your gut feelings and the general panic. The stock market is volatile. It goes up and it goes down. Your favorite stock that you bought for $20 might drop to $12 for no good reason. The human instinct is to panic and sell. But if you've done your homework, and the company story is still good, the winners are the ones who hold on, or even buy more. This is why Lynch says you should never, ever ask the question, "Is this a good market?" He says the market is irrelevant. Predicting the short-term direction of the market is a fool's game. Thousands of experts try to do it, and they consistently fail. Don't worry about the market. Don't worry about the economy. Don't worry about what the talking heads on TV are saying. Instead, he says, invest in companies, not the stock market. If you own good companies that continue to grow their earnings, you will do well over the long run. He points out that since World War II, corporate profits in America are up 55-fold, and the stock market is up 60-fold. 4 wars, 9 recessions, and 8 presidents didn't change that fundamental truth. So, once you've passed the mirror test, and you're ready to focus on companies, where do you begin? This is where Lynch gives us one of his most powerful tools, the 6 categories. He says that every stock you'll ever encounter can be sorted into one of 6 simple categories. Understanding which category a stock belongs to is the first step in knowing what to expect from it. Let's walk through them. Category 1. The slow growers. These are large, aging companies that grow just a little faster than the overall economy. Think of big electric utility companies. They used to be fast growers, but their industry matured. They're not going anywhere fast, and neither will their stock prices. Lynch generally avoids these, unless they pay a very reliable dividend. Category 2. The stalwarts. These are the giant, blue-chip companies like Coca-Cola, Bristol-Myers, or Procter & Gamble. They're not going to give you a 10-bagger, but they're not going to go bankrupt either. They grow faster than the slow growers, maybe 10 to 12% a year. Lynch likes to keep some of these in his portfolio. They're like dependable friends in a crisis. When the market panics, people flock to these trusted names. He says you can make a solid 30 to 50% on a stalwart. Then you sell it and rotate into another stalwart that hasn't moved up yet. Category 3. The fast growers. This is Lynch's favorite category, and it's where you'll find the 10-baggers. These are small, aggressive new companies that are growing at 20 to 25% a year. Think of a young Walmart, Taco Bell, or The Gap. They've found a successful formula in one location and are now rapidly expanding it across the country. This is the most exciting, and also a risky, category. These companies can flame out, but the rewards for picking a winner are enormous. Category 4. The cyclicals. These are companies whose sales and profits rise and fall in regular, if not entirely predictable, cycles. Think of airlines, auto companies, steel companies, and chemical companies. When the economy is booming, people buy cars and take vacations, and these stocks soar. But when a recession hits, their profits vanish, and their stocks can get absolutely crushed, losing 80% of their value or more. Lynch says timing is everything with cyclicals. Buying at the wrong part of the cycle is a recipe for disaster. The best time to get interested is when the industry has been in a slump for a few years and everyone has given up on it. Category 5. The turnarounds. These are companies that have been battered, bruised, and left for dead. They might be on the brink of bankruptcy. Lynch calls them the no-growers. A great example is Chrysler in the early 1980s. The company was a mess, and the stock had collapsed. But they got a government loan, restructured the business, cut costs, and came out with some popular new cars like the minivan. The stock went up 15-fold. Turnarounds are high risk, but the rewards can be spectacular. He says you can lose your entire investment, but if you're right, you can make a fortune. And finally, Category 6, the asset plays. These are companies that are sitting on something valuable that the market has overlooked. It could be cash, real estate, oil, or even a patent. The trick is to know what the assets are really worth. Lynch tells the story of Pebble Beach, the famous golf course. The company's stock was selling at a price that valued the entire company, including the golf course, the hotel, and 2,700 acres of prime California coastline, at just $25 million. A few years later, it was bought out for $72 million. And the very next day, the new owner sold off just one small part of the company, a gravel pit, for $30 million. The gravel pit alone was worth more than what investors had paid for the whole company just a few years earlier. That's a classic asset play. So, once you've placed a company into one of these 6 categories, you know what kind of story you're looking for. The next step is what Lynch calls the 2-minute drill. Before buying any stock, he says, you should be able to give a 2-minute monologue explaining why you're interested in it. If you can't summarize the story in a couple of minutes, in simple language that a 5th grader could understand, then you haven't done enough research. What should be in this story? You're trying to answer the question, what is going to make this stock go up? For a fast grower like La Quinta, the story is, they offer Holiday Inn quality rooms at a 30% discount. They do this by cutting out the fancy lobbies and restaurants, which business travelers don't need anyway. They have a clear niche, they are expanding at 20% a year, and they have a long way to go before they run out of new places to build. For a cyclical like Ford, it might be, the auto industry has been in a slump for 3 years, but now sales are picking up. Ford has cut its costs dramatically, and its new cars are very popular. Earnings are about to rebound in a big way. For a turnaround like Chrysler, the company was on the verge of bankruptcy, but they've paid off their debt, closed inefficient plants, and the new minivan is a huge hit. The company is now profitable again, and the stock is still very cheap. Once you have this basic story, you fill in the details with research. And again, Lynch insists this is not complicated. First, talk to your broker. But don't just ask for hot tips. Make them work for you. Ask for the analyst report. Ask for the company's financial statements. Ask them specific questions about the story you're developing. Second, call the company. Every public company has an investor relations department. Their job is to answer questions from shareholders. You can call them up and ask them about their expansion plans, their debt, their competition. You'd be surprised what you can learn. Lynch says he finds something unexpected and useful in about 1 out of every 10 calls he makes. Third, read the reports. The annual report can seem intimidating, but Lynch has a shortcut. He flips right past the glossy photos and the chairman's letter and goes straight to the financial statements in the back. He's looking for a few key numbers to check the health of the company. And this brings us to the famous numbers. You don't need to be an accountant, but there are a few simple concepts that can tell you almost everything you need to know about whether a stock is a bargain or a ripoff. The most famous of all is the P/E ratio, which stands for the price/earnings ratio. You'll see it listed next to every stock in the newspaper or on a finance website. It sounds technical, but it's incredibly simple. It's the price of the stock divided by the company's annual earnings per share. You can think of it as the number of years it would take the company to earn back the price you paid for the stock, assuming its earnings stay the same. A stock with a P/E of 10 will take 10 years. A stock with a P/E of 20 will take 20 years. So, is a lower P/E always better? Not necessarily. A slow-growing utility might have a P/E of 8, while a fast-growing tech company might have a P/E of 30. You can't compare apples and oranges. But Lynch gives us a brilliant rule of thumb for this. He says that for a company to be fairly priced, its P/E ratio should be about equal to its growth rate. Let me say that again, because it's one of the most valuable ideas in the entire book. A company's P/E ratio should be about the same as its annual earnings growth rate. So, if a company is growing its earnings by 15% a year, it should have a P/E of about 15. If you can buy that company at a P/E of 10, you found a bargain. If its P/E is 30, it's probably overpriced. A stock with a 20% growth rate and a P/E of 10 is a fantastic opportunity. A stock with a 10% growth rate and a PE of 20 is a risky proposition, headed for a fall. This simple comparison is one of the most effective tools an investor has. What other numbers matter? The cash position. Lynch loves companies with a lot of cash and not much debt. He tells a great story about Ford. In late 1987, after the market crash, Ford stock was selling for $38 a share. But when he looked at their balance sheet, he saw that the company had so much cash, after subtracting all its long-term debt, that there was $16.30 in net cash for every share of stock. Think about that. When you bought a share for $38, you were instantly getting $16.30 in cash. So you were only really paying about $22 for the entire car-making business, one of the biggest and best in the world. This cash provided a huge margin of safety. No matter what happened, Ford wasn't going out of business. The debt factor. The opposite of a strong cash position is a big pile of debt. Lynch says that debt is what kills companies in a crisis. He pays close attention to a company's debt-to-equity ratio, which you can find on any financial summary. A healthy company might have 25% debt and 75% equity. A struggling one might have 80% debt. For a turnaround candidate, this is the most important number to check. Book value. This is another number you'll hear about. It's the theoretical value of a company if it were to be liquidated tomorrow. But Lynch warns that book value can be very misleading. A textile company might claim its old looms are worth millions on the books, but at an auction, they might only be worth the price of scrap metal. However, sometimes book value can hide incredible assets. A railroad company might own millions of acres of land that it carries on its books at a cost from the 1800s, but which is now worth billions. This is where you find the asset plays. And finally, of course, there are the earnings. This is the bottom line. Literally. It's the profit a company makes. Lynch says that over the long term, a stock's price will always follow the path of its earnings. If earnings go up, the stock will eventually follow. If earnings go down, the stock will go down. It's the single most important factor. He shows chart after chart where the earnings line and the stock price line move in perfect tandem. A company's stock price can get ahead of its earnings for a while, driven by hype and speculation, but it always comes back to reality. And this brings us full circle. The entire process Lynch lays out is a journey to understand a company's story, backed by a few simple numbers. You start with an edge, something you've observed in your own life. You classify the company into one of the 6 categories to understand what kind of story you're looking for. You do your 2-minute drill. You do a little bit of homework to check the PE ratio, the debt, and the earnings. And then, you invest. And you wait. You don't panic when the market drops. You don't get greedy when the stock goes up a little. You hold on as long as the fundamental story of the company is still intact. And if it is, you'll be amazed at the results in a few years. This is the path to finding a 10-bagger. It's not a get-rich-quick scheme. It's a get-rich-slowly, get-rich-surely method. And it's a method that is available to anyone who is willing to open their eyes, trust their own judgment, and do just a little bit of work. Commentary. When you step back and look at the message of One Up on Wall Street, it's hard to believe it was written decades ago. In our world today, a world of meme stocks, cryptocurrency, and day trading apps that turn investing into a video game, Peter Lynch's advice feels more radical and more necessary than ever. His core idea is almost an act of rebellion against the noise of modern finance. He's telling us to turn off the TV, ignore the headlines, and look at the world around us. He's telling us that the most valuable financial information isn't locked away in some Wall Street supercomputer. It's in the checkout line at the grocery store, in the new software your company just adopted, or in the runaway success of a new restaurant in your town. What I find so powerful about this book is that it's not just about investing. It's a lesson in epistemology. It's about how we know what we know. It's a call to trust our own, direct experience over the second-hand opinions of so-called experts. In a world saturated with information, where everyone is shouting, Lynch's wisdom is a quiet voice reminding us to observe, to think for ourselves, and to have the courage of our own, well-researched convictions. The lessons are profound. Don't invest in things you don't understand. Don't try to predict the unpredictable. And above all, have patience. Investing, in his view, is not a sprint, it's a marathon. The real money isn't made in trading, it's made in owning. Owning a piece of a great business and holding on to it, year after year, as it grows. So how can you start applying this wisdom, right now, in your own life? It's simpler than you think. Here are 3 small actions you can take today. First, start your Edge journal. For the next week, get a small notebook or open a note on your phone. Every time you interact with a company, write it down. The brand of your toothpaste. The coffee shop you stop at. The software you use for school. The delivery company that brings a package to your door. Don't judge, just observe. At the end of the week, you'll have a list of dozens of companies that you have a direct, personal connection with. This is your personal hunting ground for ideas. Second, do one 2-minute drill. Pick just one company from your journal. Maybe it's a clothing brand you love, or a fast food chain that's always packed. Now, try to tell its story. In just a couple of sentences, why do you think it's successful? Is it a fast grower, expanding everywhere? Is it a stalwart, a trusted brand that's been around forever? Just the act of trying to articulate this will clarify your thinking in a powerful way. And third, find the P/E ratio. Look up the stock symbol for that one company you chose. You can do it on any free finance website. Find its P/E ratio. Then, try to find its earnings growth rate. Many sites will list this too. Is the P/E higher or lower than the growth rate? This simple exercise will take you 5 minutes, but it will make the most important valuation tool in Lynch's playbook feel real and accessible. The journey of 1,000 miles begins with a single step. And the journey to becoming a successful investor doesn't begin on Wall Street. It begins with you. With your unique perspective, your curiosity, and your willingness to learn. That was a summary of One Up on Wall Street by Peter Lynch. We've touched on the big ideas today, but a summary is like looking at a postcard of the Grand Canyon. The real experience, the awe, comes from standing on the edge yourself. The true magic of this book is in the stories, the details, and the way Lynch's humble, common-sense voice makes you feel like you have a wise and trusted mentor by your side. This summary is a map, but the treasure is in the book itself. If anything we've discussed has sparked your interest, I encourage you to pick up a copy. Reading it isn't just an education, it's an empowerment. The link to the book is in the description. Also, if this journey through Peter Lynch's wisdom has been valuable to you, please consider hitting that subscribe button and joining our community. We explore a new, life-changing book from the billionaire's bookshelf every week, and I'd be honored to have you with us as we continue to learn and grow together.